we're going to talk about that I'm excited about. We're going to talk a little bit about the stock market. We're going to review what's going on with the old stock market and kind of what it did last week. I want to talk about several topics. We're going to talk about strategies for blended families. I know a lot of you have blended families. Maybe you're in your second or third marriage, but the reality is there's some challenges financially and from a distribution planning standpoint. A lot of times folks wonder what in the world to do, and I'm going to talk a little bit about some issues there. I want to make sure you know who's talking to you. This is Russ Story. I'm your host for Money Matters. We're on Wave 94 Radio down in Tallahassee. We're on WDMG here in Douglas, and it's good to be with you. We talk about money matters, and we're going to talk about a lot of things today. Hopefully you'll get something out of today's program that you'll find is helpful to you and your family. I certainly hope that by me sharing some of the things that we've addressed and worked through with some of our sweet, awesome, beloved clients, that it'll also help you as well. If you hear something on the show today and you want to let's talk about it, or maybe there's something that you want us to talk about particularly on Money Matters on the radio, we'd be more than happy to do that. Send me an email, rstory@storywealth.com, and I will answer your email personally. And I always enjoy getting the emails. Y'all keep the cards and letters coming because the feedback is tremendous. Again, my email is rstory@storywealth.com, and just send me your questions and concerns and maybe some issues and topics that you think would be good for Money Matters. As of September the 25th, U.S. stocks really ended mixed on last Friday, and on the week as Wall Street stayed near to the sidelines. North Korea, of course, intensified its threat against the United States, and President Trump responded by authorizing sanctions against individuals and corporations who do business with North Korea. You probably have heard all about that. Meanwhile, central bank policy said basically turned investors' attention to the FOMC policy members. They left interest rates unchanged at the Federal Reserve at 1% on Wednesday. And Federal Reserve also confirmed that they will begin reducing their balance sheet by $10 billion during the month of October alone. This is a so-called wind down of the balance sheet of the Federal Reserve, where they have all these bonds there that they hold, and they're beginning to try and peel those off and sell those back to the investing public and institutional investors and the market, basically. San Francisco Fed President John Williams said he individually forecasts gradual rate increases over the next few years. He said that he thinks the new normal lending rate will be about 2.5%. If that's raising it, I don't know what is. I mean, if you can borrow money at 2.5%, you're doing very, very well. But he's talking about the prime rates or something, I'm sure, that's a benchmark. Key economic data, home builder confidence actually went down more than forecast in September. Builders grew concerned about rising lumber prices caused in large part by Hurricane Harvey and Irma. Housing starts fell by 0.8% in August, and while building permits jumped 5.6%, that's the highest level since January. So headline import prices rose 0.6% last month, and import prices, excluding oil, rose 0.3%. So export prices increased 0.6%. Philadelphia Federal Business Outlook survey rose beyond projections in September. So Federal Chair Janet Yellen has stated the Conference Board's index of leading economic indicators rose 0.4% last month, and that was over the estimates. They had estimated that it would run 0.3% as the increase. So that's positive news. So for last week, the S&P rose 0.09%, and the Dow jumped 0.36%. Small caps widely outperformed. The Russell 2000, it went up 1.35 last week. The S&P, only 5 of its 11 major sector groups registered gains. The sectors that did well, they stack up like this. Telecom was up a good bit, 3.80%. Financials were up 2.65%. Energy was up 1.98%. Real estate was down. Utilities were down as expected. Consumer staples were down. So U.S. crude oil prices rose by 22 cents a barrel last week. OPEC members gathered for a meeting in Vienna, Austria. The U.S. dollar index crept 0.03 higher to finish the week at 92.17. Treasury prices actually came down, and that sent the yield up a little bit, 4.8 basis points. Right now, the 10-year Treasury will pay you 2.25%. Okay, 2.25%. So that's sort of an update on where we are. Give you an idea, year to date, the Dow Jones Industrial Average is up 13.09%. So that's not all bad. So that's for the year to date, 13.09% on the big blue chip Dow Jones Industrial Average. If you look at some of the other indexes, the Morgan Stanley European Index is up 19.99%. And if you look at the emerging markets, the Morgan Stanley Emerging Market Index, it's up 30.16% year to date. So that is a whole sight higher and a lot more gain than the Dow Jones Industrial Average or the S&P, which Dow is setting it up about 13%. So I'm going to talk a little bit about in the next segment about diversification and what it means. I'm going to talk about some ways that maybe we should consider in the overall scheme of things, perhaps diversifying your portfolio. And we're going to talk a little bit about asset allocation and what that means and how it can be helpful in maybe smoothing out some of the returns. And also, we're going to talk about how it may, in fact, reduce risk a bit. So we're going to take a quick break, and we'll be right back with Money Matters after these words. Let me get things going here again. We'll get cranked up with the next segment. This is Russ Story with Money Matters coming back at you. We are actually on Facebook Live. It's all happening right now. We're also, we're recording our radio show for basically now it's a syndicated show, Money Matters. I'm your host, Russ Story. I'm a financial advisor. I've been meeting with clients and trying to help them solve tough financial problems for 25 years now. And we serve a lot of families in a lot of different states. We manage an awful lot of assets and personal wealth, and this is something that I truly enjoy. I enjoy my work, and I'm very blessed that I'm able to do this day in, day out. Now, as of taping, tomorrow night, we're going to have, and I'm going to mention it now because we're on the Facebook Live platform, we're having a seminar, a workshop. It's going to be at Capital City Country Club in Tallahassee, Florida. That's going to be happening tomorrow night at 6 o'clock. So if you're in Tallahassee or nearby and you'd like to attend this workshop, I don't know that we have any seats available, but I would advise you to, if you think you might be interested and want to attend, you're welcome to give us a call, 912-384-0030. Talk to Deborah at this point and ask her if we have some room available. But we're going to have a meal, we're going to have some awesome cookies, and we're going to hopefully have a good time. So at this point, let me mention a few things as of local note. The Childhood Cancer Awareness Campaign finished up last weekend, and there was a silent auction and also a live auction, and they were incredible. They raised an awful lot of money, raised an awful lot of awareness concerning childhood cancer, and I tell you, the folks that participated and organized that Phi Beta group here in Douglas, they always do a fantastic job. So kudos to you guys for awesome work and what you're doing. Also, I want to mention that, oh yeah, let me tell you what, I'm just going to throw this out because over in Ashburn, Georgia, there's a restaurant. Let me tell you what, it's a gem in the rough. Do you hear me? It's you got to get off 75 and go in there, and it's basically in the corner of a shopping center over there. But it's called Little Bighorn Steakhouse. Little Bighorn Steakhouse in Ashburn, Georgia. And Bill and Tiffany are over there. And if you have a time to hop in your vehicle, ride your motorcycle, or however you like to get around, I'd encourage you to go over there and enjoy one of the best steaks that you'll ever put in your mouth in Ashburn, Georgia at Little Bighorn Steakhouse. I'd encourage you. Go see Bill, Tiffany. You'll be glad you did. You can look them up on the internet. I'm not sure what their telephone number is, but I would call and let them know you're on the way. So I wanted to mention that. Good food. I mean, fat boys like me, we enjoy a good steak. And I know that you do as well. So tell them Russ sent you over there, and you'll be glad you went. So let's talk a little bit about diversification. Let's talk a little bit about what happens and why we might diversify. There's been an awful lot of study on this subject. And me as a financial advisor, one of the things that I am always looking for are ways to reduce my client's risk. But also we want to make hay while the sun shines, right? I mean, we want to make as much money as we can, but at the same time, we want to protect our assets and manage the wealth so that we don't lose what we make. And I think that this is a very misunderstood situation. I know this week I looked and reviewed a client's portfolio. They've got money in several places, and they figure because they've got it in several places that they are well diversified and they don't have all their eggs in one basket. Well, they don't have all their eggs in one basket, but the places where they've got the money, it's all invested in the same stuff. So, you know, it's all the same kind of eggs in the basket. So Harry Markowitz won a Nobel Prize in economics. He came up with what's called the modern portfolio theory. This was back during the 70s. And basically what he theorized was that we can greatly reduce, this is his theory now, we could greatly reduce risk by having a portfolio that was designed and had negatively correlated asset classes in other words, when one asset class is going up, the other one might be going down, but one offsets the other, and you kind of have this kind of deal. So ultimately it goes up as a whole, but you can protect and reduce your volatility by asset allocation and doing that properly. So no matter what you do with your money, no matter what you do, there's some type of risk involved. Now you say, well, I just don't want to lose my money. Well, that's losing money risk right there. But if you invest, you could suffer a loss unless you're in an investment that has a high degree of guarantees. If you stay in cash, inflation will erode the value of your savings. So that is a losing proposition. You say, well, I'll just do nothing. I'll just keep my money in CDs. Well, historically, you're backing up because you don't make enough to offset taxes and inflation. So what good is putting the money away if you're not keeping up? I mean, you probably be just as well to spend it in a hard asset. But you can design your portfolio so the risk you're taking is appropriate for you. The key is we call asset allocation. Okay. Asset allocation refers to the mix of investments inside of your investment accounts. How much stocks you have, how much cash you have, how many bonds you have, and other asset classes. They also, and also you look at the investments within each class. So although terms like diversification and asset allocation are basically used synonymously, if you listen to CNBC, they're really different. True diversification means investing in a mix of assets that do perform differently in different environments, different market conditions. And if stocks fall worldwide, for example, other assets like bonds or cash or alternatives may buffer your portfolio against losses until the stocks recover. So how do you know? Well, Russ, okay, well, great. What would be my mix? How do you determine what the proper asset allocation might be? Well, there's a couple of things to begin with. We want to determine your time horizon. One of the things we look at is, okay, Russ, I got some money. Okay, well how much you got, and how long are you going to want to let that money cook in the oven before you take it out and want to use it? Also, risk tolerance. Your financial ability and emotional ability to take risk in pursuit of reward. That's important as well, and we look at that when we're trying to make a recommendation or advising you on your asset mix. You know, a conservative allocation may be 50-60% in bonds, maybe 30% in stocks, and maybe 10% in alternative type investments. A more moderate may be 20% in alternatives, 50% in stocks, and 30% in bonds. So, you know, it depends, but stocks and bonds and cash have always been, long been, a building block of investor portfolios. Now alternative investments, institutional money managers more and more use what we call alternative investments, what's an alternative investment? Well, it's anything besides stocks and bonds and cash, basically. Okay, so, well, how about commodities, Russ? Yeah, that'd be an alternative. What about non-traded real estate? Yes, that would be one. So there's a lot of alternatives now, and we have so many options that we didn't have before. So we've come a long way, and now the retail investor. So once you establish the right asset allocation model, now we go a step further. One of the things we do is we use a retirement asset allocation software program to help us give you the highest opportunity for success based on a historical perspective. And that's something that, you know, I go over with my clients. That's something that you may or may not need, but if we were doing a full-blown plan for you, that's one of the things we'd look at. Because really and truly, we want to give you the best opportunity to succeed that we can. We want to put the odds in your favor. And, you know, as closer we can get to 100%, that we're going to achieve the goals with the least amount of risk, then that's what we're trying to do. So once you've established this asset allocation model, you got to monitor it regularly. A portfolio that starts out with 60% stocks and 40% bonds, for example, may go to 50-50 if bonds outperform stocks over a period of time. Well, then your asset allocation gets out of kilter, as my grandmother would say. And so now what you got to do, you got to realign this thing. You can rebalance the portfolio. You sell the assets that are up and you reshuffle the mix to put it back in a 60-40 split. Now, the closer you get to your financial goal, your ideal asset allocation mix typically will change. Sometimes it'll change drastically. So generally, the less time you have before you reach the goal, the more conservative your asset allocation should be. But that's a general rule, and I'm speaking very generally. Everybody's situation is different. We're going to take another break. We'll be right back with Money Matters. Don't go away. All right, this is Russ Story back at you with Money Matters. I'm your host, Russ Story. I am a financial planner. I'm a financial advisor. Been doing this for a long time. I've been at this for about 25 years, and I have dealt with hundreds of awesome, wonderful, greatest people in the world clients for a long time, and I'm very, very proud of the relationships that we've been able to build over the years. If you're a client of ours, I want to thank you very much for giving me the honor and the privilege to work for you and your family. And we appreciate every day that you spend as our client. And thank you for your referrals. Thank you for your business and friendship. I want to talk a little bit about asset allocation. That's what I was talking before the break. And a couple things I want to mention to you. The one thing that a lot of people don't like to think about is an asset class called international investments or global type investments. And one of the things that I talked about at the beginning of the show, if you remember, before the break, was that year to date, the European index and the emerging market index have beaten the pants off of our good old American Dow Jones Industrial Average. I mean, the return has been a whole lot higher. And you say, well, Russ, what in the world? Well, I kind of thought that'd be the case anyway. Some of the investments that we've weighted toward have a good bit of weighting in the international high-quality markets. And, you know, a lot of times folks go, look, I'm already scared enough investing any money in the U.S. stock market, you know. But the reality is I want to continue to invest, but I'm a little bit worried about those international investments. I don't trust people over there. Well, the reality of the situation is now in the United States, we don't have a monopoly on the investment markets. As a matter of fact, most of the investment opportunities, good quality investment opportunities as well, are found overseas. A lot of big companies, you know, Nestle's is over there. They're not a U.S. company, and I could go on and on. But at the end of the day, you know, having some international investments may be a good idea for you. You know, any time that there is a growing middle class in a country, then that typically is very positive and very good for companies. Most companies with well-known global brands have international roots and may not be included in mutual funds and other investment strategies that are focused on U.S. companies alone. I'll give you an idea. Through international investments, you can participate in world economies, in business cycles, in their currencies, in stock price valuation, and global leaders. So I think it's important that we consider some international investments. Now, I'm not talking about, you know, Sudan or some crazy dictators. No, absolutely no. But there are good, high-quality international investment opportunities that are there. And a lot of times, let me put it to you this way. If you went to the grocery store, okay, as a financial advisor, I look at it this way. If you go to the grocery store and you say, well, here's the grocery store, and I'm only going to shop on the first 3 aisles. I'm not going over there to the rest of them. Now, there's 12 aisles in this grocery store. But I'm here at Kroger or wherever, and I'm only going to shop on the first 3 aisles. Well, when you have the mindset that the only investment that you're going to invest in with your investment portfolio is strictly domestic, you know, stocks, bonds, whatever, then you're really just shopping on the first 3 aisles of the grocery store, and you're missing a whole lot of stuff on the other. There may be some great, you know, bargain on sale on our aisle 5, and you just missed it because you aren't willing to consider. So when it comes to asset allocation, I'd encourage you to consider different things. Consider broadening your horizon, if you will, because it allows you sometimes to capture some better return. Now, last but not least, I'm going to switch up a little bit. I was going to talk about financial strategies for blended families, but that's such a big topic, and I'm winding down. I don't have a whole lot of time. But I do want to cover this. I call it tax watch. The Republicans have basically slipped out and talked about some provisions in the new tax scheme that they've put together. And I'm going to tell you this. My opinion is if the Republicans don't get their act together here pretty soon, there's going to be a groundswell, and a lot of people through disappointment are going to be voted out of office in the Congress as well as the Senate. So I want to talk a little bit about some of the things they're talking about, and if this is in fact the case, then we need to keep up with this, and we need to make sure that we address this and make sure that this doesn't go through. It looks like you know one of the things they've done. They've said that they've been leaning hard on what they say is a provision to cut and simplify taxes for the middle class. Well, that sounds great, and that's what we all hope will happen. But if you look at the plan in its entirety based on what we're seeing now, the plan would actually increase the standardized deduction available to taxpayers by about 15%. Okay, well, that's not bad. That would mean that, most everybody would get a tax cut, right? Well, what it means is that taxpayers who wouldn't take the standard deduction and those who instead deduct things like mortgage interest would actually pay on more of their income than they do now. Well, that's not good. Okay, that's penalizing those folks with mortgage and other deductions. It's also important to realize that according to what I've read recently, to simplify the tax rules, the additional standard deduction and personal exemptions for taxpayer and spouse are consolidated into this larger standard deduction. So basically, without getting into a lot of the minutiae, it looks to me like the Republican plan would replace the provisions with a single deduction of $12,000 or $24,000 for married couples. That would be a 15% increase, except for seniors. And seniors would only get a 3% increase. Now, why they threw that in there, I'm not sure. If I was a senior, I wouldn't be very happy about that. So the first dollar of taxable income would be subject to a 12% rate instead the current 10. But don't worry, the framework says additional tax relief, although it's unspecified, will emerge during the committee process. So let's hope that's the case. Now, if you have children, the fate is uncertain as well. The plan looks like right now it would abolish $4,050 exemption you get for each dependent child, but it would also increase the child tax credit by an unspecified amount. So once the amount gets specified, we'll be able to figure out if we face a tax increase, a tax cut, or what. So anyway, the Republican proposal says most itemized deductions would be abolished. They do say that you could retain mortgage interest and charitable giving, that would be retained. So currently you get to take a personal exemption even if you also itemize your deductions, but you only get to take a standard deduction. So you forgo the itemized deductions, if you forego the itemized deduction. So if you combine the provisions into a single standard deduction, it would mean itemizers lose their personal exemption. They get nothing back, meaning they'll typically pay on an extra $4,050 worth of income if they're single and $8,100 if they're married. So we got to keep an eye on this, and I'll make it my job to keep you informed. We need to hold these guys accountable, and that ain't what we elected them for. What we asked them to do was to look after us and clarify and cut through some of this stuff and give us some incentive to go back to work and allow the private citizens to keep more of what they make. Anyway, we'll keep you informed. Hope you guys have a great weekend. It was a pleasure being with you, and I thank you for having me here today and being with me and listening. Again, keep the emails coming. ourstory@storywealth.com. Go to our website, storywealth.com. And check out what's going on. We got a lot of stuff happening. We appreciate you. Thanks for listening, and have a wonderful, wonderful weekend.